Hey, welcome to The Explainer. Today we're diving deep into Elite UK REIT's latest results for the full year 2025. We're going to really get into the numbers, figure out what's making them tick, and most importantly, what it all means for the future.
All right, let's kick things off with the number that really jumps off the page for any investor, 5.6%. Now that's a year-over-year increase in something pretty crucial. Hang tight, because we're going to break down exactly what that number means for the bottom line.
Okay, but before we jump into all the juicy results, let's do a super quick refresh on who we're talking about. So Elite UK REIT, they're what's called a real estate investment trust. You'll hear it called a REIT, R-E-I-T, all the time.
So what on earth is a REIT? Well, think of it like this. It's a way for you to invest in a whole bunch of properties, office buildings, that kind of thing, but without having to actually buy a single building. And the best part? For your investment, you get a piece of the rental income that flows in. It's a lot like getting dividends from a stock, really.
Now, what makes Elite UK REIT so interesting, especially if you're an investor who likes stability, is their whole business model. I mean, they own 148 properties, right? Valued at just under £425 million. And get this, their main tenant is the UK government. We're talking about essential places like job centers. So their income is not just rent, it's an incredibly secure government-backed stream of cash.
Okay, so now that we're all on the same page, let's dive into those 2025 results. And, I'll give you a little spoiler. There was some seriously good news for their investors.
And this is where we come back to that 5.6% we mentioned at the start. So what does it mean? It means a full-year payout of 3.03 pence for every single unit you own. That is a fantastic 5.6% jump from last year, going straight into investors' bank accounts.
Right, and in the REIT world, this payout has a special name, distribution per unit, or DPU. Honestly, this is the number that matters most. It's the key metric for seeing how a REIT is really doing, because it's the actual cash that lands in your pocket.
So how do they pull off that DPU increase? Well, it's pretty straightforward, actually. The total pool of cash they had available to pay out to investors grew by 4.6%, climbing to over £19 million. It's like they say, right? A bigger pie means everyone gets a bigger slice.
But here's where it gets really clever. This growth wasn't just about collecting more rent. I mean, think about it. At a time when rising interest rates are a huge headache for almost every company out there, Elite UK REIT actually managed to lower their borrowing costs. That is a seriously smart move, and it meant more money for investors and less for the banks.
Okay, but any good investor knows you got to look beyond the headlines, right? So while the payout to investors was up, which is great, the whole story is a little more complex. Another really important number, the net property income, was actually down.
And that brings up a huge question, one any investor should be asking. If their total revenue went up, how on earth did the income from their actual properties go down? Let's unpack this little mystery.
Yeah, the numbers here tell the whole tale. Total revenue? It edged up 1.3% to £38 million. But the net property income, and remember, that's what's left after you pay for all the direct costs of the properties, that actually dropped by 3.7%.
So what gives? Well, the key thing to understand here is that this dip wasn't because their main rental business is struggling. Not at all. It actually came down to a couple of one-off things. First, they spent some money strategically to get certain properties ready for new uses, and second, they just didn't get as many one-time payments from tenants for things like wear and tear as they did the year before.
And that mention of strategic spending is actually the perfect segue into what we're talking about next, the company's plan for the future. It's super clear they aren't just focused on today, they're actively building for tomorrow.
Just look at this number for a second. 7.2 years. For any investor, a number like that it's a huge signal of stability. It screams long-term, predictable income. Let me tell you why.
It's all about a metric called the weighted average lease expiry, or WALE. Yeah, W-A-L-E. By locking in new, long-term leases with the UK government, Elite REIT has managed to extend its WALE to a really healthy 7.2 years. What that means in plain English is over 7 years of predictable, guaranteed rent coming in the door. That is fantastic.
And check this out. This is a perfect example of their growth strategy playing out in the real world. They aren't just sitting back and collecting that stable government rent. No way. They're actively moving into really high-demand sectors like student housing by converting some of the buildings they already owned. And this whole growth plan is only possible because their foundation is just rock solid. I mean, just think about it for a sec. Their main tenant is the AA-rated UK government. There's no currency risk because everything they do is in pound sterling. And they don't have to worry about refinancing any major debt until 2027. That's a powerful mix, like having a championship defense and a really clever offense.
All right, let's boil all this down. What does this all mean for you, the investor? What's the real bottom line from all these numbers and strategies?
I think the CEO really summed it up perfectly himself. He said they've laid a solid foundation with these mission-critical properties that offer recession-proof yields and future growth. That's it in a nutshell, a super stable base with a clear plan for what comes next. So yeah, the bottom line is pretty clear. 1. Investor payouts are growing, and that's thanks to some really smart financial management. 2. Their core business is incredibly stable with those government leases locking in income for years. And 3. They've got a very clear plan to diversify and grow into new areas. It's a solid story.
And all of this really leaves us with one big question to think about. When you combine that kind of government-backed stability with a smart, new focus on high-growth sectors, is that the winning formula for the long term? Something to consider.
And before we go, just a quick but important note for you. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.